Hello, everyone. Today is Friday, April 22nd, 2022. My name is Evan. Welcome back to our weekly stock market analysis video series. We do these every Friday and we break up our analysis into two parts. In part one, we look at everything that went on this week in markets. We go beyond price action. We look at market internals, volatility, interest rates, commodities, really sort of just pick apart things that stand out, look different or interesting. And then in part two, we jump into those charts. We're going to be doing a price action analysis. We're going to be looking at natural gas today, volatility, gold, and then some sectors and industries of note. So hopefully that sounds good to you. Let's jump into some of the takeaways from this week, some of the highlights from this week. Really, the story was this Thursday and Friday 1-2 punch. We saw markets basically start the week pretty unfazed, pretty quiet, and generally to the upside. And on Thursday, we got this reversal session that took place. And then on Friday, we got some pretty significant follow through to the downside in the market. We also saw the dollar break to new fresh multi-year highs, and we saw gold actually reverse lower. So a bearish sort of reversal there on gold, which was just a candidate that was starting to break out. So no real protection in the old yellow rock this week. If we take a look here at the numbers, you can see on the right hand column it was really ugly out there. So basically all the way up to upwards of 4% lower in the major indices. The Nasdaq 100 hit the hardest here, down 3.86%. We saw the S&P down almost 3%, Russell over 3%. So really it was pretty broad-based, relentless selling out there. And we are going through earnings season. We had a few notable earnings. Netflix is clearly the one that comes to mind first in terms of the pulling down the Nasdaq and the sort of spread over to what some of these other companies might be facing, but earnings continues to rage on. If we take a look here at some trend analysis here, so this is our smart trend filter applied to all the major indices here. And remember last week we were temporarily, if you look at where my mouse is here in the top left, S&P 500, we were temporarily above our smart trend filter. So this yellow, green, red dotted line here, we were showing how it's still printing yellow, trying to turn up. Let's see if the bulls can kind of hang on to the strength, the rebound, the bounce. And now, of course, you can see right back down we go, and closer to those February, early March lows. So S&P 500 back below, still yellow. Q's breaking and pulling in a fresh sell signal here. So this simple sort of price volume over time analysis here basically objectively gives us this reading here that these longer term trends, they're still in trouble, they're still hurting, and the market is still pointed lower. Russell 2000 fresh sell signal here. Same thing with international stocks, ACWX. Fresh sell signal as well. This indicator is available for TradingView TC2000 on our website. If you do want to download this, you can get it there. Now, in terms of market internals here, no saving grace either. We saw, Wednesday, which was a slight bright spot there in the markets. That was the early week sort of, rosy, kind of uplift to start the week. And then, Thursday, Friday, we basically came crashing back down. So 759 in aggregate, new 52-week lows made this week. NYSE cumulative AD line 2687 to the downside, and percentage of S&P 500 stocks over 20-period SMA 31.08%. So pretty ugly out there. Actually don't know that this number is accurate. I think I was having a slight data problem here. This was probably even more negative than 2000, but anywho, pretty close. And again, these are unsettled numbers. So if we take a look here at the 52-week highs over a 30-day look back, you can see basically this is the trend of what stocks are doing, what the broad NYSE, how many stocks are hitting lows versus highs, and you can see that trend continues to the downside. And this is basically the underpinning here that the market is still in this very vulnerable and unpleasant phase where it's being mostly seeing distribution among stocks, and selling pressure continues to really now pick up to the downside here. We had this brief period of sort of stable sideways action, and now we're starting to just leg lower again. So nothing too pretty on this chart. Bears in control. If we take a look at VIX here this week, jumped pretty big all the way up to the upper 20s. I think we got close to 30. I don't think we got to 30 on Friday's session, but we settled around 27.87. That's a big jump, and you can see the curve is flattened here, which basically indicates that the immediate term protection, the immediate term fear and uncertainty out there is peaking, as this front month VIX price is, almost equal to 3 months out in time. That is not a traditional comparison here or look in healthy market environments. So the market clearly now ramping up its protection and protecting from that continued downside move. If we take a look at sector performance, we did, have two sectors staying in the green here. We had real estate rebounding 1.27%. We had consumer staples up 0.5%. Those were the only two sectors that managed to stay green this week. Everything else was in the red. If we take a look here at the downside, we had communication services getting crushed the hardest, almost 8% down. That was a huge move for the XLC. We had energy down 4.5%. We had materials down 3.7%, and lots of other sectors down 2% or more. So this was, again, the real sort of troubled view here. If we take a look at the 1 month look backs as well, so you can see real estate, consumer staples, and utilities, pretty defensive. I mean, real estate obviously has its own sort of anomalies or factors that are driving its performance here. But, when you look back 1 month and the only thing that's green is staples and utilities, tells you a lot about the market environment we're in as well. So if we head to interest rates here, you can see yields are up again. Notably, they are starting to slow down a little bit. I mean, it's, we've been looking at this very closely here, along with pretty much every other technician and economist. All of the interest rates here, we're just putting that magnifying glass on here to try and find some type of bottom, some type of reversal, some type of evidence of a slowdown. And again, maybe in terms of momentum, we're starting to see again some divergence really kind of creep in here, but generally speaking, yields still up across the board, but slower than maybe prior weeks. So maybe we're again getting close, but that's been just a losing call to make, is because interest rates continue to rise, bond markets, bond proxies there continue to fall. We did see LQD, JNK both continue to fall this week as well. Now, in terms of the dollar, it broke out to new highs. So this was your saving grace here. This was your defensive asset. This is the only thing that really got you paid this week. If you own dollars, if you own the UUP, especially against a basket of other currencies, then you did pretty well this week. Gold was down 2%. Unfortunate to see on a pretty tumultuous week. Would have expected that to do a little bit better. Silver down, Bitcoin flat, ag was down, oil down, natural gas falling back down as well. We'll talk about that chart a little bit later. So that is pretty much everything here. I wanted to throw in the correlations just towards the end. There's nothing really new here. Again, you're seeing the bright green across equity markets, so indicating that there's essentially uniform movement across all major assets or indices. And then you also have the strong negative inverse correlation to the dollar, which just continues to basically stay very tight in its correlation. And again, this is usually what you see during those periods of stress. Now, if you take a look at our trading systems, we'll wrap it up here before we jump into the charts. You can see our top trading system, Merlin, here is our longer term system, 34% invested. Didn't really do, I don't think anything this week. I think it held pretty much the positions it held on to. No profit targets, no stop losses. Again, mostly cash and defensive, but still has 34% in the market. Our shorter term trading system down here, Lamerick, this has been going, really back and forth, juking and jiving, pretty much enjoying this market environment, or at least treading water to maybe slightly pulling in some gains here week over week. It is going into the weekend a little bit net long, but still, again, nothing aggressive, 15% to the long side. I think it still has a short position on, and then a few longs. So that's the way it's positioned. If you want to learn more about these trading systems, check out that $1 trial we have available on our website. Gets you access to our nightly trade reports. You can see kind of what's going on at a closer frequency, and then you can decide if it's something you think is beneficial to your trading, to your investing, to your approach to the market. So check it out there, traderisk.com/trial. So with that, we'll be back here in just a second with part 2. All right, we are back. We've got TC 2000 open. We're going to dive right into some price action analysis of the S&P 500. Now, the highlight from the week, one of the big takeaways here was just the very violent Thursday, Friday sell-off. And you can see it here. Just look at the magnitude, look at the size and range on these two bars here. So we essentially tried to push higher on Thursday. We failed, we reversed, we closed all the way back down to the bottom end of this little mini range we were carving out. And then we got some aggressive follow through on Friday and really more expansion in range and a close at pretty much the lows of the session. So this is pretty much as bearish as it gets in terms of price action analysis. If we even take a step back and sort of think about how we got here, remember the market consolidated here for just about 4 or 5 days, and it doesn't seem like a lot, but when the VIX is north of 20 and we've got all this, geopolitical stuff going on, we got the Fed, we've got earnings season, right? We have all these catalysts hitting us day after day, and the market basically just stood sideways here, just chopping around in a very tight kind of range for 5-6 sessions. And what that did was it just sort of, coiled the spring a little bit, just coiled up everyone, buyers and sellers all kind of coming together, agreeing at this particular, in this general zone. And eventually you get that expansion in range out of it. It first did this quick head fake to the upside, like it was going to break out, resume, and kind of move back up towards highs. And then, of course, by the end of the session, that was pretty much negated. And then you got your breakdown to the downside. So when we look here at the immediate price action, that's what's going on. If we take a step out and just zoom out to these bigger levels, we've been really trying to keep things simple. Looking at this view here for the most part, right? We've got our big kind of support drawn down here around 4,200. We've got our big resistance up here around 4,600. And that's the playground. That is the big range, which from low to high is basically 10% that we're seeing the market digest sideways in. And so what we've effectively done now is almost round trip this move from the lows in early to mid-March that we made from, again, 4,200 all the way up to 4,600. Remember, we did that in 2.5 weeks, really 2 weeks of trading from the lows to highs. And now over the course of 3 weeks, we're basically just giving this all back. And it wouldn't now surprise me to see us just move right back down to this 4,200 area. And that is the key area. So we failed to break up around 4,600. Now that we're coming back down towards this 4,200 zone, the March lows, the February lows, that is what we want to have our attention on. That's certainly what has my attention from a bigger, broader macro perspective. If we break down through this 4,180, 4,200 zone, and we start breaking to 6-month lows, 7-month lows, that's going to be, that's going to be a problem, and that's going to be a very ugly leg down. If we start breaking below here, we could calculate some measured moves, right? We could get down to, probably somewhere in the long lines of the 4,000 range or upper 3,000s. We're not there yet. Not even suggesting it's the highest probability scenario at this time, but we've just got our roadmap here. We know what levels we want to pay attention to, and the market is just in a very high volatile state right now with a VIX up around 25 or even close to 30 where it is now. You should expect that we're going to see these ranges continue to stay expanded, and right now the sellers are definitely in control. There are, a couple of points of maybe some hope. If we throw Bollinger Bands on this chart, take a look at the S&P 500. We're pretty significantly below the lower Bollinger Band right now. Again, markets, they don't typically like to stay down there too long. When they're in a strong trending mode, they can definitely persist below a expanding lower Bollinger Band. So that is the fear here, is just this meltdown that could occur. So let's keep that in mind. But we are certainly showing some signs of, just a oversold nature. And again, take that with a grain of salt, because it might not mean, in fact, it definitely does not mean that just because this is below this magical dotted line here, you should be buying, or that the market can't go lower, because that is certainly not the case. If we take a look here at the Russell 2000, this is again sort of the concerning point. Now we've been looking at it, let's say throw on this weekly chart, right? We've been looking at it with, let's see, kind of this view here. I guess we haven't updated this too much. We had a couple of legs down here. We had this little wedge that it sort of broke down from. Let's go back to a daily chart. So you can see the ultimate low is down here around 187, but the bulk of where buyers have been stepping in is pretty much right in here, right? We saw the market sell off repeatedly down to about the lower 190s, and that is almost always where we saw the reversal take place. We had a couple of instances down here around 188, but you're basically coming now back into decision mode here for the Russell 2000. So if we start, very similar to the S&P 500, if we start breaking down below this, this gets really ugly really quick, and this could be a very nasty leg down if the Russell 2000 starts cutting below 188 on a closing basis. That would be a very sort of bearish development there. We'll see if it happens. Weekly chart, again, doesn't look all that exciting, especially, again, when you kind of take it in context from this big leg down, consolidation for 6 weeks, or I'm sorry, 6 months, and then a potential breakdown or rollover is just a very dangerous recipe. So again, not saying it has to happen, not saying it will happen, not saying it's the most likely scenario, but it's something we're going to keep an eye on around this low 190s area here. And if we look at the Nasdaq 100, again, you can see this one really unraveling pretty much the quickest here. Ugly Thursday, Friday session coming back down to these March lows. How does it act at the March lows? Can the buyer step in again? Can we hold over 315? Those are the things we're going to be looking at. And again, we have lots of earnings to digest, to look at, and to react to. So this will be an important week as we start to move into some of the more tech influential, heavier names that are reporting. If we look at Apple, for instance, that's a next week report. We can look at Microsoft, which is next week as well. Google is next week. So we've got lots of things. Tesla did report and didn't do a whole lot in terms of movement, but those are some of the big names that we've seen, that we have coming up next week. So let's now jump into a couple of other charts here. Natural gas, this is one I wanted to talk about. So natural gas really ran away to the upside here. So it's been in this really just accelerated trend higher, right? Really kind of, moving at that speed, and then you can see the real acceleration sort of take place on these last few days here. We broke below the accelerated trend. We're starting to break below this other slope as well, and we're starting to just pull back a bit here. So I don't have a position in natural gas. Natural gas is a really tricky one to trade. This is oftentimes, it's just messy, lots of gaps in this particular commodity. But, when it trends, it certainly trends, and there is a lot of beta behind it. But it's kind of resetting now. If you think this is something that can persist here, if you think, we're on this, commodity boom for the natural gas and oils, then you'd be paying attention to this pullback here, as it's now about 18% from its highs. So natural gas, no position in it, not really a thing I trade too often. So I probably am just going to be an observer on this, but if you are interested, I know I've got some comments that come in for natural gas specifically, then you're looking for this to just kind of settle out a little bit, put in some type of higher low, and hopefully off to the races it goes. We can also take a look at VIX, which is what I wanted to do, and this is the 28. So 28 VIX going out into the close here. Look at this move. Throw Bollinger Bands on the VIX, right? I don't do a whole lot of heavy TA on it, but again, you can see very very aggressive move up here, basically 40% rise in the VIX over here in 2 sessions. So that's a lot of, demand for protection. And, sometimes that can mark those temporary bottoms is when everybody's protected. The selling pressure can dissipate. So something to keep an open mind on. But, if we start really climbing above 30, again, very dangerous for what happens above 30 in the stock market. Now, gold here was unfortunate to see. I thought this was going to start to move a bit here. I like the fact that last week it started to close over these multi-week lows, and it looked like it could start to get some legs here. But basically, we had this bearish engulfing weekly bar that took place. It's a pretty ugly bar, heavier volume. Seemed like it should have gone up here. So for me, that kind of dampens my enthusiasm pretty dramatically on gold. Again, it's still holding over this 177 level, so there's still some hope here, of course, that it just needs more time to kind of settle in, build a bigger base, and then start to move up. But that immediate term momentum is gone, so it's just a little bit less exciting from at least a trending momentum perspective. Now, last but not least, let's take a look at some of the sectors and industries of interest. There was clearly nothing on the upside, so this is a screen that we have, a layout we've built for TC2000. If you're a user, you can get this on our website as well as a download. But basically, the only thing that's showing up this week are things on the downside. So let's take a quick look at them. We got airports and air services, big high volume outside reversal bar. You got basic materials, aluminum, big heavy expansion to the downside. Financial services got new lows. Cyclical here. Look at the attempt at higher and then the rejection and close near the lows for auto parts. Healthcare was rough. Biotech specifically. Capital markets, new lows here. Tech, communication equipment, new lows. Big reversal again. Electronic gaming and media, new lows. Financial services, data specifically, new lows. We had health and information services, new lows. Home improvement making new lows. Internet content information, new lows. Diversified media, new lows. Medical care breaking down pretty dramatically here. That was a rough week, 10% down. More medical, new lows. Oil and gas equipment, just a high volume reversal here off of its uptrend. Paper and paper products, reversal. Software, new lows. And then you just have the XLF outright with some new lows, XLK new lows, SMH new lows. So lots of very unattractive bearish looking charts there. We've got some short-term signs that maybe there's some exhaustion. We've seen a big jump in the VIX. So, maybe they're shaking the tree pretty dang hard right now, and there's some buyable opportunities, but those trends are down, and there's a lot to be concerned about when you look at internals, market internals, and then just those overall trends. So be careful, be cautious. More advanced traders, obviously, you've got the advantage of higher volatility. So your day traders and even the overnight swing traders can get some more ranges out of these stocks, but you got to be careful. You got to know your time frame, your strengths, and really sort of just wait to make sure it's the right opportunity and market for you. So that's it. That's what I have. Hopefully everybody managed to get through in one piece. Leave me your thoughts. Leave a comment below. Let me know how you're thinking about this market. And as always, I want to thank you for tuning in every Friday. Long form market analysis videos just like this. You can subscribe on our YouTube channel or stay up to date at thetraderisk.com. Have a great weekend. We'll see you back here next week.